Let's slow this down and really walk through what just happened because on the surface, it looked simple. A jobs report came out. The headline number beat expectations. Markets initially cheered, gold and silver dropped fast, risk assets bounced, end of story, right? Not even close. When I look at the full employment data, not just the headline that flashes across your screen for 10 seconds, I see something very different. The prior numbers were revised down sharply. We're not talking about a minor tweak. We're talking about a downward adjustment of 862,000 jobs. That is the largest negative revision since the aftermath of the 2009 financial crisis. Let that sink in. Nearly 1 million jobs simply erased in revisions. And when you zoom out further, the pattern becomes even more uncomfortable. Over the last 3 years, employment data has consistently been revised lower. First 2023, then 2024. Now 2025 shows even deeper adjustments. At one point, cumulative payrolls had been overstated by over 1 million jobs compared to actual records. The initial narrative says strong labor market. The quiet revision months later says something else entirely. For 2025, total job growth now stands at just 181,000 for the entire year so far. That averages to roughly 15,000 per month. Compare that to 2024, which added 1.459 million jobs. That's not a gentle slowdown, that's a dramatic deceleration. Yet the markets initially traded as if the economy is firing on all cylinders. Gold and silver were hit immediately after the headline release. That's standard behavior when traders interpret strong employment as reducing the need for Federal Reserve easing. But here's what's important. Both metals retraced nearly all of those losses quickly. As I'm speaking, gold has pushed above $5,100, confirming a breakout. That tells me something fundamental underneath the surface is far stronger than a single headline number. Silver's pricing structure is even more revealing. In Western spot market, silver has been trading around the mid-80s, futures slightly below that, but in Shanghai, spot silver has been trading near 90 and futures around 93. That's a $6 premium in the physical market in China compared to Western pricing. In my last update, that premium was closer to 377. It has effectively doubled. Premiums like that don't happen randomly. They signal tight physical supply and strong localized demand. The Shanghai Futures Exchange data is public. Anyone can look at it. The front-month contract has been trading at a record premium over the next active month. That's backwardation, when near-term supply is valued more highly than future supply. In commodity markets, persistent backwardation is often a symptom of physical stress. What's driving it? Several factors appear to be converging. Investment bar demand remains elevated. Solar manufacturing continues to consume significant volumes of silver. Deliverable inventory has been tightening. Short sellers in China have reportedly been paying deferral fees to avoid physical delivery. That is not normal behavior in a relaxed supply environment. That's what happens when material is scarce. Now layer this on top of what's happening at the COMEX in the United States. February silver deliveries reached 23 million ounces, representing 45,592 contracts. That figure exceeded the entire open interest that existed in the February contract at the end of January. In other words, more than 100% of open interest resulted in delivery notices. When deliveries exceed the starting open interest of a contract, that tells you physical demand overwhelmed initial paper positioning. That's not theoretical, that's recorded in daily delivery reports. Looking ahead, the March contract currently carries open interest equivalent to roughly 342 million ounces of paper silver claims. First notice day for March delivery is February 27. That's when traders must declare whether they intend to take physical delivery or settle in cash. If delivery demand remains elevated anywhere near February's pace, the system faces a significant physical test. Can exchanges manage this? They have mechanisms. Contracts can be rolled forward. Cash settlement can be encouraged. The system has tools to prevent outright failure. But tools are not the same as infinite physical supply. Now consider timing. The Shanghai Metals Exchange closes for Chinese New Year from February 15th through February 23. That creates an 8-day window where Eastern physical buyers are largely absent from active price discovery. Historically, periods when major physical demand centers are offline can coincide with increased volatility in paper markets. Without strong Eastern bids absorbing selling pressure, Western institutions have more room to push prices in either direction. But here's what's different this time. The Chinese market entered this holiday period already in record backwardation and carrying that $6 premium. Physical tightness was visible before any temporary closure. When trading resumes after the holiday, the premium behavior will matter. Does it persist? Does it widen? Does it collapse? That will tell us a lot about whether this is structural or temporary. Now let's connect all of this to the broader economy because commodities don't exist in isolation. Corporate bankruptcies are rising. 9 large U.S. companies filed for bankruptcy last week. The 3-week rolling average sits above 6 large bankruptcies per week. That's the highest pace since the COVID-era disruptions. Consumer debt delinquencies are also climbing. The total delinquency rate across all outstanding U.S. household debt has reached 4.8%, the highest level in 8 years. That's Q4 2025 data. If employment were truly booming, would we see rising bankruptcies and accelerating consumer defaults? Possibly in isolated pockets. But when you combine downward job revisions of nearly 1 million positions with elevated delinquencies and bankruptcy filings, a more fragile picture emerges. Meanwhile, commodities have surged over the past year. Silver is up roughly 150%. Gold has climbed 76%. The dollar index is down about 10%. Those are not typical strong economy price signals. That combination looks more like currency debasement meeting constrained supply. Nominal prices rise while real economic activity underneath weakens. Equity markets reflect that tension. The S&P 500 dipped modestly. The Nasdaq slid slightly. The Russell 2000, which tracks smaller companies more exposed to domestic economic conditions, fell over 1% after initially rallying on the jobs headline. Crypto markets erased nearly $90 billion in market capitalization in a short window. Bitcoin dropped below $66,000. Ethereum touched $1,900. That kind of whipsaw volatility usually appears when markets are struggling to reconcile conflicting signals. Strong headline, weak revisions, tight commodities, rising defaults, flat bond yields. Speaking of bonds, the 10-year Treasury yield has barely moved over the past 3 months, hovering around 4.17%. If the labor market were genuinely reaccelerating, you would expect yields to climb meaningfully as traders price in higher growth and possibly tighter monetary policy. Instead, yields remain flat. That suggests bond markets are not fully buying the strength narrative. Technically, silver also flashed an interesting signal. The price dropped to around $82 and briefly fell below the 150 exponential moving average on the hourly chart. That 150 EMA had been acting as support for weeks. When silver broke below it earlier in the cycle, we saw a sharp drop from around $90 down to the low 60s overnight. This time, after some consolidation, price reclaimed that level and moved back above it. Is that a guarantee of higher prices? Absolutely not. Technical support must hold on retests. Volume must confirm, momentum must build. But when technical structure begins to align with strong physical premiums and elevated delivery activity, it adds confluence. Now, there are bearish considerations. January still showed 130,000 jobs added, with unemployment at 4.3%. That's not recession-level unemployment. Markets can continue rallying on headline data for extended periods before revisions gain traction. Silver remains volatile and capable of sharp moves in both directions. Contracts can roll forward before first notice day, reducing immediate delivery stress. Cash settlement can be enforced if necessary. The Chinese New Year closure also creates a temporary window where Western markets may dominate pricing without Eastern physical absorption. Technical support could fail. Prices could retest lower levels before any genuine supply crunch materializes. Corporate bankruptcies are elevated but not yet at 2008 crisis levels. Consumer defaults, while at 8-year highs, are not catastrophic. So this is not a doomsday scenario. It's not a guaranteed breakout either. It's a structural tension building beneath the surface. What makes this moment particularly important is the divergence between physical and paper pricing. A $6 premium in Shanghai is not a trivial arbitrage gap. When one region is consistently willing to pay materially higher prices for immediate delivery, while paper markets price lower, credibility begins to erode on the paper side. Price discovery ultimately depends on real supply and demand. Paper contracts can suppress volatility for periods of time, but they cannot manufacture physical metal. The next critical date is February 27th, first notice day for the March COMEX silver contract. Open interest currently represents hundreds of millions of ounces in paper claims. The registered inventory backing those claims is finite. Watching how many contracts stand for delivery versus roll forward will be key. After Chinese markets reopen, watch the Shanghai premium. If it narrows significantly, perhaps the tightness was temporary. If it widens further, that suggests continued physical stress. Watch Treasury yields. If they remain flat despite positive headlines, bond traders may be signaling skepticism. Watch bankruptcy filings and delinquency rates. Those are real economy indicators that don't care about narratives. Most importantly, look at the original data releases yourself. The Bureau of Labor Statistics publishes benchmark revisions. Delivery statistics are updated daily. Exchange inventory reports are public. Debt delinquency data is accessible through Federal Reserve databases. These aren't hidden numbers. My role here is not to tell you what to buy or sell. I'm not issuing trading calls. I'm connecting dots that rarely get connected in mainstream discussions. Employment revisions of this magnitude matter. Physical premiums of this size matter. Delivery percentages exceeding 100% of open interest matter. Rising defaults matter. You can interpret them however you choose. We are in a period where nominal asset prices may continue rising even as structural weaknesses deepen. That's a classic late cycle environment. Currency can weaken while commodities strengthen. Headlines can appear strong while revisions quietly undercut them months later. The real question is whether paper pricing mechanisms can continue to dominate discovery if physical demand continues pulling metal out of the system at elevated rates. That answer won't come from a single trading session. It will unfold over weeks and months. So watch February 27. Watch what happens after the Chinese New Year closure. Watch whether silver holds technical support above that reclaimed moving average. Watch whether gold sustains its breakout above $500. Watch whether corporate bankruptcies accelerate or stabilize. Watch whether delinquency rates climb further. And above all, don't rely solely on headlines. The initial print is rarely the final story. Revisions reshape reality. Physical flows reveal stress before it shows up in official narratives. This is not about hype. It's not about fear. It's about logic, structure, and evidence. The data is there. The patterns are visible. The divergence between what's said and what's revised is measurable. We're going to keep tracking it carefully, piece by piece, because when markets shift structurally, they usually give signals long before the consensus acknowledges them.